Accelerated depreciation. Can you go into detail a little bit about that? What do you mean by that and how somebody could maybe take advantage?
Yep, absolutely. So when you buy a residential property, let's call it a single family home or perhaps a multifamily property, that's going to be depreciated over 27 and a half years. So let's just take a quick example. If you had a $500,000 property, land is never depreciated. So let's just say that 80% of that building, that value is dedicated to the building. So that means over four, that's 400,000, and over 27 every year for 27 and a half years, you're gonna get roughly $14,545 of depreciation. Now, if you have a commercial building, it's depreciated over 39 years. So it's actually gonna be lower than that. However, there's something called bonus depreciation, which allows you to accelerate the depreciation on components of the property that have a class life or a depreciable life of 20 years or less. So typically what you'll do is you have a property. Now I'm going to give an example of this, but typically you'll have a property. You'll have what's called a cost segregation study performed on that property. And a cost segregation study is where an engineer comes down to your property and classifies each component of it and gives you a printout and says, okay, here's the amount of your property that's 27 and a half year property. So that's going to continue to have to be depreciated over 27 and a half years. But here's the part of your property that's going to be 15-year property, which is also known as land improvements. Here's the part of your property that's going to be 5-year property, which is going to be tangible personal property, things like light fixtures, things like that. And somewhere between 20 to 30%, depending on the property, location, a whole bunch of details, can be reclassified to this 5 and 15-year category, where those would be accelerated by itself. Like it would just depreciate over 5 and 15 years, which is shorter. So you'd have a higher depreciation expense. But really, the power of this since the Tax Cuts and Jobs Act of 2017 is bonus depreciation. So right now, bonus depreciation is 60% in 2024. So to kind of give an example of this, same $400,000 property, let's just say that 25% was reclassified in a cost segregation study to this 5 and 15-year property. That's going to be roughly $100,000. Now, if you're able to use bonus depreciation on that, 60% of that, you're going to get a depreciation expense in the first year of $60,000. So this is a non-cash, this expense only exists on paper. So if you go back to that example we had before, where you had maybe, well, 500,000 property, probably closer to 10. So if we just kind of take a zero off those numbers, you have $4,500 or $4,500 in expenses. Now you have $5,500 in cash flow, but now you have this massive $60,000 non-cash depreciation expense. Now you have a tax loss in that first year, $54,500. So that's substantial. Now, if you're a passive investor, that will either offset other passive income you have, or it'll be suspended, carried forward to future years. Can offset that. But if you're a real estate professional, now this can offset your active income. This is why they love to combine it with cost segregation and bonus depreciation. You get these massive losses that can significantly reduce your tax liability.
Hmm. Just to remind everybody, head over to Thomas's website. It is therealestatecpa.com/Thomas, therealestatecpa.com/Thomas. It's going to be a clickable link in the show notes. If you found some value in what we were talking about so far here today, do us a quick favor, share this with one of your investor friends. So, this cost segregation strategy, there seems to be a lot of balls in the air. At what point do you find that it's worth it? Is this worth it for a single family rental, or is it worth it more for those multifamily properties?
Yeah, that's a great question. So on multifamily properties, it's almost always worth it. Most investors that I've worked with have always wanted to opt for this. But when you get down to single family properties, in some cases, it could be cost prohibitive. However, there's something that has came out recently over the last few years, and I mean recently, maybe the last 10 years or so, called a desktop study or software cost segregation study. And they typically do these on properties that are less than $1 million. But basically, what you do is you will input information into a software about your property. So the size of your property, square footage, amount of rooms, fixtures, things like that. And then that software will basically do the cost segregation study for you. So you're not actually having to bring an engineer to your property. They're not having to survey your property. They're not having to go and put the man hours into it. And that software will give you that study. And it will be approximately the same, give or take, depending on the specific property of what you'd get with a normal study. So we've seen those because they're usually, I think, less than $1,500. In many cases, I think you get one for as low as $600. We've seen them be profitable or be cost effective on properties that are as low as $150,000, and certainly on properties that are $500,000.
Hmm. And this is something that is accepted now in the industry, that the software, because it seems like you, or is this
Yeah,
something that gets caught in audits, or how does
yeah,
that?
Yeah, that's a great question. So traditional cost segregation studies, those have been around for a long time. The IRS approves of them. There's an entire guide on how to do those, actually. In fact, it's the right way to depreciate a property, but the IRS isn't going to come after you if you don't do it. Now, the software ones, there's a big concern around that for a lot of people. And a lot of the companies who offer these studies do offer audit support. So we always recommend, if you do purchases, get the audit support. One of the companies we were speaking to, I think it was last year in 2023, they had actually went through an audit. So one of their clients had gotten audited, and they were able to successfully defend the audit with their software, showing how it worked and everything like that. Now, part of the reason why they do it on smaller properties is because there's a lot less risk, right? And when you have a bigger property, there's a lot more components, there's a lot more things that could potentially go wrong. One of the companies does it on properties that are $600,000 or less, and then the other one does it on properties that are a million. And in certain instances, I believe they can go up to 3 million, depending on the situation.
Hmm. So I'm going to tackle a couple pretty big subjects here now. And we've been pretty much talking about rental properties up until this point, but a lot of people, when they get into real estate investing, they usually tackle wholesaling and fix and flipping. So you get these huge capital gains on some of these properties. Is there anything that we should be aware of that can mitigate that outside of the rental properties
The
as a
balance. Yeah.
balance?
Yeah, absolutely. So wholesaling is typically going to be considered ordinary income. You're receiving fees in exchange for finding a property for somebody else, basically. And that is going to be taxed at rates up to 37%, just like you're basically running a business. So you have self employment tax, you have the federal taxes, and same thing very much for flippers. And when you're flipping properties and you're holding properties out for resale rather than for rent, it's considered inventory, much like a car dealership has cars. They're not depreciating those cars for the most part. At the car dealership, they're holding it out for inventory. So when they sell a car, they're paying ordinary taxes on it, just like, in the wholesaling situation. So in many cases, flippers will be subject to those ordinary tax rates as well. Now, the way to mitigate taxes on that is one way to do it is to consider establishing an S corporation. So before I get into this, I want to preface this by saying, don't ever put a rental property in an S corporation. A lot of downsides. But when you're flipping properties or you're wholesaling properties, if you do it in an S corporation, what the S corporation allows you to do is pay yourself a wage or salary. And then the profits are not, so that the salary will be subject to the FICA or self employment tax, whereas the profits will not. So, what some flippers or wholesalers will do, and same thing with real estate agents, they'll do the same thing. They'll have an S corporation, they'll have all their income from the wholesaling, the flipping, perhaps if they're an agent, all going into the S corporation, and then they'll pay themselves a salary and be able to reduce their exposure to the self-employment tax, which is 15.3%, up to, I believe in 2024, it's around $163,000 of income. So that can save people tens of thousands of dollars per year just doing that.